Hi, this is Anmol Gupta. And if you want to understand the very basics of income tax, like what is TDS, what is ITD, what is ITR, why do you need to file ITR, what are exemptions, what are deductions, this video is for you. Probably you have also registered for my tax saving workshop. So this video is a prerequisite for you if you don't understand these basic terminology. Once you understand these basic terms of income tax, you will be able to take maximum advantage of my tax saving workshop. And if you haven't registered for my tax saving workshop yet, what are you waiting for? Check the link in the description and sign up for it now. Also guys, unlike my other videos, this video is going to be purely in English because I'm primarily creating this video for my taxing workshop participants. So let's start. I'll answer two very basic questions first. Number one, why do you get taxed? And number two, how do you get taxed? So why do you get taxed? The answer is very simple. The roads that you see, salary of your policemen, salary of the government employees, all the government departments that are running, the bridges, the dams, all these things, the common amenities of a country, all these expenses are taken care by the tax that we pay. Tax is the major source of revenue for the government. Without tax, the government cannot function. And we primarily pay taxes in two different forms. First is direct tax, second is indirect tax. Indirect tax is whenever you buy something, right? Like when you buy a bike, when you buy a car, when you buy even a small thing like chocolate, you always pay GST on that, right? So whenever you're spending some money on buying anything, you pay GST on that. So that is called as indirect tax. But you are watching this video to understand direct tax, the tax that gets levied on your income even before it gets credited to your salary. And that is exactly why you have joined my taxing workshop as well. You want to save income tax. It's not like you don't want to contribute towards the development of the country, just that you're paying a lot of tax and you want to save some of that. So now that you know why you get taxed, let's understand how do you get taxed. Now in our country, not everyone needs to pay direct income tax. Alright. Anyone who's earning above 5 lakhs in a year, only that person needs to pay income tax. Now if you are earning above 5 lakh in a year, government won't send its agents every month at your doorstep to collect tax, right? Has it ever happened with you? Never. If some collection agent is coming at your doorstep every month to collect tax on behalf of the government, that person is fooling you. Please don't pay any tax to any random person. So how do you get taxed? It's very simple. If you are salaried, then your company, your employer is supposed to deduct tax from your income before even crediting your income to your bank account, and then pay that tax to the government. And this tax that your employer deducts even before crediting your income to your bank account is called as TDS. Tax deducted at source. Now you might make a lot of fun about your HR and admin departments, right? But they do a lot of work on your behalf. It is their responsibility to ensure that whatever tax you are supposed to pay to the government gets paid to the government. So whenever the financial year starts, first, they are supposed to estimate your 12 months income, next 12 months income. Then they are supposed to estimate how much tax will you need to pay based on that estimated income. Then they are supposed to ask from you if you are going to adopt some of the tax saving strategies in order to reduce your tax liability, and then adjust your tax liability based on that. And after doing all these calculations for each and every employee, they start deducting TDS monthly from your income. Trust me, it's not an easy job, it's a thankless job, and you still make fun of them. By the way, if you are an HR or an admin taking care of all of these things for your employees, hats off to you. Now you might ask, why are these people deducting tax in advance when you have not even earned the income for the entire year, right? Why can't they ask you for the tax at the end of the year? So answer is very simple. Just like you need money on a monthly basis to take care of your expenses, government also needs money on a monthly basis to function. How else would the government employees get their monthly salary? Now the tax that you're supposed to pay to the government can be accurately calculated only after the year is ended, right? Because during the year you might have used some of the tax saving strategies because of which your tax liability would have reduced. And it might have been the case that your employer has deducted more tax than you were supposed to pay. So this is where income tax return comes into picture. After the financial year has ended, government wants you to calculate accurately how much tax were you supposed to pay based on your income, based on the tax saving strategies that you use, and then calculate how much tax did you already pay. Based on that, whether you paid more tax or less tax. If you paid more tax, then government will return you the balance with interest. But if you paid less tax, you have to return the balance, or you have to pay that remaining balance to the government with interest. So just contributing towards development of your country is not enough. You are also supposed to do accounting of that. So this is ITR, income tax return. Every year you have to file this. Now, what can you do if you don't want your employer to deduct more TDS? If for sure you know that I'm going to adopt these 3-4 different tax saving strategies during the year, so my tax liability would be lesser than what my ideal tax liability should be, right? So can you do something so that your employer deducts your tax liability based on your planned strategies? The answer is obviously yes. So at start of the financial year, even when you have not executed any strategy, right, like maybe some tax saving investments or some tax saving expenses, right, even when you have not done any of those things, just that you're anticipating that I'm going to do these kind of things, you can tell those things to your employer so that your employer can consider those things and reduce your TDS. And this is a very formal process in every company. It's called as ITD, income tax declaration. It is done at start of the financial year. Your HR or admin is not getting any fun out of this process. It's for your own benefit. So it's a very ideal scenario when you're able to plan all your tax saving strategies at start of the year itself and tell it to your employer during the ITD process. Your tax deduction would be lower. But even if you don't happen to declare all the income tax declaration at start of the financial year, even if you happen to get more TDS deducted during the year, it's totally fine, because actual calculation happens when you actually file the ITR. At that time, the final settlement is done. So even if you end up paying more tax than what you're supposed to pay during the year, don't worry. You get your tax back, you get your extra tax back when you file the ITR. So far we have covered three basic terminologies: TDS, tax deducted at source; ITR, income tax return; and ITD, which is income tax declaration. So for my freelancer friends who are working on their own, who are earning a business income, your client is supposed to deduct TDS on your payments, all your payments. You would have seen that your client is always asking for your PAN number in order to deduct your TDS. If your payment from a client is more than 30,000 rupees, your client is supposed to deduct 10% TDS on your income. And not just this, every quarter you are supposed to estimate your tax liability based on last quarter's income and pay the advance tax to the government. So it's a bit of an additional work if you are a freelancer or if you're self-employed. Now let's discuss how your income tax is calculated, how your tax liability is calculated. Now you would have seen these tax slabs, right? Up to 5 lakh of income, from 2.5 to 5 lakh of income, tax is 5%, from 5 lakh to 10 lakh it's 20%, above 10 lakh it's 30%. I'm talking about the old regime. So let's say your yearly income is 4 lakh, alright? The tax rate between 2.5 lakh to 5 lakh of income is 5%. So what do you think? How much tax you need to pay to the government in that year? Now you might simply calculate 5% of 4 lakh and come to a conclusion that your tax liability is 20,000 rupees a year. Right? If you're an absolute beginner, if you don't know about how the taxation system works, this might be your answer. It's totally fine. This video is very basic anyway. So no, you don't need to pay 20,000 of your 4 lakh income in taxes. That's huge. Alright. So this system is called as marginal taxation system. So when government says that from 2.5 to 5 lakh of income, we want to charge 5% of the tax. What government wants to say is from 0 to 2.5 lakh, nothing is taxed. So since you are earning 4 lakhs in total, right? Your income from 0 to 2.5 lakh will not get taxed at all. Now above 2.5 lakh, whatever income you have got, about 2.5 lakh and below 5 lakhs. So between 2.5 to 5 lakh, you have got 1.5 lakh of income, right? That 1.5 lakh will get taxed at 5%. So 5% of 1.5 lakh is 7,500. That is your tax liability. If your annual income is 5 lakh rupees, then your taxable income would be 5 lakh minus 2.5 lakh. So that 2.5 lakh will get taxed at 5% and it's going to be 12,500. So at 5 lakh of income, your tax liability would be 12,500. But now here is a twist. Up to 5 lakh of income, you would have heard that you don't need to pay any kind of tax, and that is true. But your actual tax liability is there, right? At 4 lakh of income, your tax liability is 7,500. At 5 lakh of income, your tax liability is 12,500. Then how come you don't need to pay tax? So a few years back, government came up with this rule that up to 5 lakh of income, whatever your tax liability is, we will give you that amount as rebate. It's kind of a refund that government is giving you. So whatever tax you're supposed to pay, government will refund you that money. In reality, your employer won't even deduct any kind of tax if your income is less than 5 lakh, because anyway you are going to get that money back from the government even if you end up paying that tax. So up to 5 lakh, effectively you don't need to pay any kind of tax. In legal terms, if your income is 4 lakh, your tax liability is 7,500, but you're getting 7,500 as rebate from the government. If your income is 5 lakh, your tax liability is 12,500, but again, you're getting 12,500 as rebate from the government. So government has capped this rebate limit at 12,500. So up to 5 lakh of income becomes non-taxable effectively. Now here is an interesting thing. What if you earn 5 lakh 20,000? How much tax would you need to pay? So from 5 lakh to 10 lakh, the tax bracket is 20%. So let's calculate it. From 0 to 2.5 lakh, you are not paying any tax. From 2.5 to 5 lakh, you have a tax liability of 5% of 2.5 lakh, which is going to be 12,500. And between 5 lakh and 10 lakh, you have an income of just 20,000 rupees. 20% of that 20,000 would be 4,000 rupees. So 12,500 plus 4,000 is 16,500. But now you might say that 12,500 would be refunded, right? From 2.5 to 5 lakh, government is giving that tax liabilities rebate, right? But that's not the case. If your income rises above 5 lakh, you need to pay tax on the income which was between 2.5 to 5 lakh as well. Unfortunately, this rebate is not applicable if your income jumps slightly above 5 lakh as well. So at the income of 5 lakh 20,000, your tax liability would be 12,500 plus 4,000 is equal to 16,500. So your net in-hand income after tax would be 5 lakh 3,500. On the other hand, if someone is earning 5 lakh exactly, that person will take home 5 lakh itself. Even though you are earning 20,000 more than that person, you are taking home only 3,500 more than that person. So it is what it is, and it matters only if your income is right above 5 lakh, it's little above 5 lakh. If your income is way beyond 5 lakh, this thing is not going to matter to you. But I'm assuming that if you have registered from a tax saving workshop, you are earning much beyond 5 lakh, because that's when the tax saving strategies comes into play. Now, what are these tax saving strategies that I've been talking about so far? So I'll be going into the nitty-gritties of these strategies during the workshop, but here I just need you to understand the high level concept. Now, to understand that, you need to understand another term, and that is taxable income. Now, your taxable income is not same as your salary. It's not same as your CTC, right? It's going to be either equal to your salary or CTC, or it's going to be lower than your CTC or salary. And in most of the cases, it's going to be much lower than your actual CTC or your salary. Point is, you don't pay tax on your salary or your CTC. You pay tax on your taxable income. Now, you cannot reduce your salary or CTC, right, just to pay lower tax. You would not want to do that. But there are strategies to bring your taxable income down. There are legal methods to bring your taxable income down. And on a high level, there are two different ways to bring your taxable income down. First is exemptions. Second is deduction. Don't get scared by these terms. I'll just explain these. So first, let's talk about exemptions. Now, if you're earning a salary, you would have seen your salary slip, right? And if you haven't seen your salary slip yet, I highly recommend you to go through that, because you are going to need that salary slip during my workshop as well. I'll not be asking that from you. You'll just need your salary slip to do your own tax planning. Now, let's say your CTC is 12 lakh, right? Now, in your salary slip, it will not be written that you are getting 1 lakh per month, right? Your 1 lakh income per month would be divided into different components. The most common component that you'll find in anyone's salary slip will be basic salary. After that, you'll have things like HRA, house and rent allowance, you might have meal allowance, you might have telephone allowance, you might have leave and travel concession, you might have some special allowance, you might have some other allowance, you might have fuel allowance, you might have XYZ kind of allowance in your salary. And after adding them all up, you'll get your total salary. Now, why this salary structure is so complex? Why can't they put everything in just one kind of component? Like, why can't they just put everything in the basic salary, right? So the thing is, it's for your own benefit. Some of these allowances are not taxable, while some of these allowances are taxable. For example, your basic salary, it's a fully taxable component of your salary. So if your entire income is just basic income, your taxable income would be equal to your CTC. Like HRA. HRA is a non-taxable component. There are different restrictions and terms and conditions, but a part of HRA is non-taxable. Meal allowance up to a certain limit, that is also not taxable. So all these components of your salary which are not taxable are called as exemptions, because they're exempted from tax. So it's always better for you to have more and more exempted components in your salary, so that your taxable income is far lower than your actual salary or your actual CTC. Now, concept wise, it's very straightforward that you need to have more and more tax exempt components in your salary. But when it comes to actual implementation, there are some rules and restrictions in place, like your HRA can't be this much, your meal allowance can be only a maximum this much, which is non-taxable, your basic has to be this much percentage of your salary. So considering all these rules and restrictions, designing an optimal salary structure becomes a challenge. But with my tax planning tool, I've made this work much easier and much straightforward for you. So when you're going to come into my tax saving workshop, you are going to use my tax planning tool to optimize your salary structure for maximum exemptions, subject to all these rules and restrictions. So it's a mathematical optimization problem that we have solved using my tax planning tool. It's very hard to do manually, but I've done that using my tax planning tool. It makes your work much easier. And if you're a non-salaried person, this exercise is going to open your eyes, and I'm going to show you how having a salary for your own self, even if you are self-employed, how creating a salary for yourself using legal entities can be beneficial rather than earning as a sole proprietor. Now, the very last basic thing that you need to understand before you join my tax saving workshop is deductions. Now, naturally, you'll not be able to make your entire income exempted from tax. You'll not be able to have 100% of your salary component as non-taxable. The law doesn't allow for that, right? Even after optimizing your salary for maximum exemptions, you'll have a significant taxable income left. Now, government has specified a certain kind of expenses and a certain kind of investments, and if you incur those kind of expenses and if you happen to make those kind of investments, whatever amount you incur as those expenses or whatever amount you invest in those kind of schemes, that amount can be deducted from your taxable income to bring your taxable income down. That is why it is called as deduction. Example of such an expense is paying for your life insurance. Example of such an investment is investing in public provident fund, right? And there are 15-20 other types of deductions that you can avail. So we'll be covering all these deductions in my tax saving workshop, and my tax planning tool is also configured with all the rules and regulations so that it becomes very easy for you to plan these deductions. And it's not about claiming these deductions randomly. It is about claiming these deductions in the right manner so that it doesn't adversely affect your overall financial planning. Instead, it should be aligned with your overall financial planning. That's going to be my objective during the tax saving workshop. So guys, these were the basics that you need to understand to take maximum advantage of my tax saving workshop. In this video, we discussed TDS, we discussed ITR, we discussed ITD, we discussed how to calculate your income tax liability, we discussed what are exemptions, we discussed what are deductions. So I hope this was useful, and I can't wait to see you in the workshop. And if you haven't signed up for the workshop yet, link is in the description.